Well, how's it going, friends and family? Welcome to another episode of Compounder's Corner. In this video, we'll be going over the companies that are reporting their earnings this week and the stock market in general. By the way, my name is Amos, and I got roughly 4 hours of sleep last night, and I bit my tongue eating breakfast this morning, so it's awkward to say some words. And in case you missed it, I just uploaded a video about SCHD's 2026 reconstitution on the channel, where I talk about each of the individual stocks that were added and removed. Go and give that a watch if you have not already. So, what have we got going on this week? I think the biggest blue chip name is going to be Nike, and they're reporting their earnings after the markets close on Tuesday. Here's the thing. I think even if Nike crushes expectations because of the tariff situation and Chinese consumers picking other brands, I think the stock price, no matter what happens, it's going to sink. Besides, at the time of making this video, their forward trading multiple is a 28. And I think based on the trailing 12 months, present tense PE ratio, it's like a 31, 32. So they're not cheap by any means. And then we also have the food CPG players, such as McCormick and Conagra brands. The entire industry is selling off. Even General Mills, PepsiCo, the high quality ones, doesn't matter. They're all getting punished. And that's because right now, they're losing ground to private label brands, and even if they make it themselves and put a different label on top of it, the margins are not going to be that pretty if you go the private label route. So there's a lot of other factors that are happening as well. I posted a huge dedicated deep dive on the Patreon on the landscape of food CPG stocks. I personally sold all of my food CPG stocks at a loss last year because between you and me, not to be a negative Nancy, I do not think they are done selling off yet. And it's crazy to say. Another food CPG player is going to be Lamb Weston. They pretty much supply all of the French fries, tater tots, and anything potato-related product to every restaurant here in the US. So it's an indirect play on the restaurant category as a whole. Personally, I'm not bullish about that. If you're bullish on French fries, you might as well invest into McDonald's, right? And there's also another food CPG player, Cal-Maine Foods. They're reporting their earnings. They're one of the largest egg producers in the US, and I actually made a dedicated deep dive video on them if you want a full breakdown. So if we're going to be honest with one another, this week isn't that exciting, but it's another week where investors and big money, hedge funds, and everybody else on Wall Street, they're going to be holding their breath as to what the US president is going to choose to do next. Because right now, the reality is we're about to experience stagflation. And I'm sure you've heard that term thrown around here or there, but it's about to become a reality. And it's essentially when the economy suffers from high inflation, slow or stagnant growth, and rising unemployment all at the same time. So when you think about it, it's a really bad operating environment for publicly traded companies, but also the working class families. And mind you, this is a direct consequence of the Middle East conflict because of the oil shortage and everything that's happening. I mean, just take a look at the gas pumps, right? Even here in Japan, we're starting to feel the effects. And in places in Southeast Asia, like the Philippines, Vietnam, and Thailand, I know they're running really, really low. Just watch what happens to the global supply chain once this oil crisis gets out of hand. And I already think it's out of hand, but the fact that it's only going to get worse, because I don't think a resolution or an end to the conflict is going to happen anytime soon. I'm not trying to be a Debbie Downer, but based on my understanding of the landscape, I think we still have, best case scenario, a few more weeks to go. Worst case scenario, it's going to be drawn out like the Ukraine-Russia conflict for years. And if that is to be the case, dude, yeah. So I can see why the stock market is selling out, but as retail and amateur investors, we're feeling the effects, right? And what really frustrates me is that we were making progress to a soft landing. We were about to pull off the crazy, the impossible, but that's out the window. I don't think that's going to happen. So I think you can look at this as a terrible situation. And granted, I think there's some merit to that. But on the other side of that coin, I think for those that are in the wealth accumulation phase of your life, need I remind you, right? Market downturns like this is a correction. We're 10%, 15% off from all-time highs like 6-7 months ago. Market downturns, they serve as a primary engine for long-term growth. What I mean by that is, if your retirement, when you decide to press the button to stop working or showing up to whoever pays you every week, if that stole away like by a year, 5 years, or even 30 years, being a net buyer of equities is an advantage right now, as lower prices allow you to acquire more shares with every dollar invested. My whole thing is, if you fancied VU, the S&P 500 ETF, at let's just say $500, and now it's $250, why would you not want to buy it when it's 50% off, right? Like, I don't know if that's the actual price. Let me just look it up real quick. Okay, so I wasn't too far off. At its high about 6 months ago, they were $641 for VU, Vanguard's S&P 500. Now they're $582, and it does seem like they're headed down towards $550, $500. And worst case scenario, we should be seeing $400 a share coming up, if April 2025 isn't any indicator of what's to come. So if you can buy the stocks that you've been eyeballing for the longest time at 20, 30, 40, 50% off, why not, right? Because obviously past performance is not indicative of future gains. What happened in the past is not what's to come in the future. However, historically, and the data shows us that most major downturns, they resolve within 3 years. And in modern times, I would argue it happens within like 3 to 9 months. Even the pandemic sell-off, even the April 2025 sell-off, what have you, we rebound and rally back to all-time highs in a matter of months. Obviously, right now, we're in a free fall. It's falling fast and it's falling aggressively. If you look at the Fear and Greed Index, I think this week we're going to hit single digits. I think we closed the market on Friday at a 10, and you ideally want to see that number, in a perfect world, be at 90, right? The market to be greedy. But in a normal trading day, it should be around a 50. An equal number of buyers and sellers. As of right now, everyone is panic selling. That's what the data shows us. So my whole thing is, during prolonged periods of stagflation, like the lost decade from the dot-com bubble crash in the year 2000 all the way up to like 2010, it was pretty much flat. It rewarded disciplined and patient investors. The folks that are just consistently contributing money to their 401k or to whatever brokerage account through the lows when the stock market is fearful and things are selling off, that's what allow you to build wealth. Like, you can make money during a bull market, right? However, you can get really rich during a bear market. I don't know if I said it the right way, but I remember hearing that phrase from one of my MBA professors quite a while ago, and it just stuck with me. Like in a bull market, yeah, we can all make 20, 30, 40%, okay? But in a bear market, when you buy into the best of the best companies, when they're also getting punished alongside with everyone else and they're 50 or 80% off, that's when you truly build generational wealth. So I'm trying to say this strategically, keeping the optics of during the bad economic downturns, yes, people are going to be experiencing some rough times, right? So it's not an environment and situation where you should only be thinking about, oh, how I'm going to be making money. Because the reality is there's going to be a lot of people that are also going to be hurting, right? But if you're an investor, despite the fear and panic, I think stocks selling off, it's a fantastic buying opportunity. That's not financial advice. I'm just talking to myself, and it's exactly my game plan, my execution, what I plan to do. And I'm just going to be buying stocks. Other people, yes, sit on the sidelines or do whatever you have to. But for me, that's what I'm going to be doing. Now, obviously, this strategy, it sounds super easy and doable on paper, in theory. But the reality is, it's going to be much harder. When you see your portfolio, when you see your beloved stocks selling off day after day, like ServiceNow, Adobe, Procter & Gamble, are you truly going to have what it takes to remain a steady, disciplined investor? Right? Truth is, not many people are going to be able to do it. People sell and they pull their money out and they're fearful and they're going to miss the rally back up. That's what's going to happen. On paper, it makes all the sense in the world to invest into high quality compounders when they're going on a clearance. The reality is, not many people are going to be able to do it. So, me personally, my portfolio has taken a huge hit this week. Actually, for the past 2.5 to 3 weeks, my portfolio has been taking a beating. But I don't know if this is words of comfort or if we're in denial or if this is like a therapy session, 5 of us sitting in a circle. But it doesn't faze me because I'm not a day trader. Like there's folks out here that buy into a stock and try to sell out of it on the exact same day. Like they buy into it at 10 a.m. and they try to sell out of it by 12 p.m. and then they panic when they're down by like 2% or like 20% or whatever. They're playing with options. That's not me. My positions in my public portfolio that's available on the channel and my investing horizon, it's for another 20 to 30 years if God lets me to live for that long. I'm 35. I've got grandparents that are pushing 90, so genetically I should be able to live for a lot longer, but point is, I've got time on my side. So why the heck would I not want to buy into stocks right now? Historically, look at the great financial recession, 2008 to 2009. Imagine the folks that bought into that dip. You fast forward to 2026, they're happy, right? I think I told this story once on this channel before. One of my MBA classmates, absolute sweetheart, he became a millionaire by putting his entire inheritance from his grandfather into a specific REIT. I can't remember it off the top of my head. I think he put like 28, maybe 38 grand. And by the time you fast forward 15 years, he was a millionaire. And he was telling me how he was utilizing the dividend income from that REIT. He never sold out of it to pay for his bills because he had like 6 kids or whatever, maybe 7. And the funny thing is they were all daughters. So I think about his story, and he's one of the ones that kind of planted a seed in my head about how you can actually build generational wealth in the stock market. Because at the time, I wasn't an investor. Matter of fact, I feel like I started late in the game because I had no financial literacy or education in terms of equities and the stock markets in general up until I got my master's degree. And that's when I realized, like, holy moly, like the true path to becoming wealthy in life is to have income producing assets under your name. So when you buy into a publicly traded stock, you become a shareholder and that asset belongs to you. And that's why I always say I'm a dividend growth investor. Why buy into a stock that does not pay a dividend? Because when there's an economic downturn or a correction or a pullback like we see right now, you're not going to get anything from it, right? It's going to be negative 40% in your portfolio and you're not going to get anything. But with a dividend paying position, if you experience some speed bumps and some headwinds, it's business as usual. You're still going to get that passive income as long as it's high quality. So even though right now it's disappointing to see the red across the board, I know over the grand scheme of things, everything's going to be okay. And so I'm continuing to put my money where my mouth is. And I guess I'll elaborate on that here in a little bit, but I wanted to change gears a bit and talk about the Mag 7. Time and time again on the channel, I always say that money can be made in any sector, any industry, as long as you go for the best of the best, like the market leader. You don't have to just invest into tech. You don't have to just invest into AI or drones. No, you can actually make money from gas station stocks. You can make money from manufacturing stocks. So my whole thing is, when the entire market sells off like it is right now, I think the Magnificent Seven, they tend to have some of the best risk to reward when their valuations are less than their historical average. So if you take a look at your screen right now, Nvidia, year to date, negative 10%. Apple, I don't think they're a good deal right now. Talk to me when Apple is around 180 or 175 a share, when their trading multiple is around an 18 to 19. As of right now, I still think they're a little too expensive. Google, negative 12% year to date. Microsoft, negative 26% in the red in the past 3 months. And then Amazon is negative 13%, Tesla is negative 19%, and then Meta is negative 20%. And so when the entire market sells off, me personally, I'm not going to go anywhere near companies that are in the D tier or in the C tier. If you're a friend of the channel, then you know when I analyze and evaluate a company, ultimately towards the end, I give a grade, a stamp of what caliber or quality of a company they are. And if they are an A, that means they're excellent, superior. If they're a B, they're above average. They should be getting market-beating returns and they're doing everything right. If they're a C, that's where the bulk of the publicly traded companies fall under that bucket. They're average. They're doing exactly what they should be and so forth. So my whole thing is I don't want to go anywhere near companies that are D or F. Right now, when everything's selling off, why entertain the rebound stories, the turnaround stories, the cigar butts? Warren Buffett even said, right, one of his biggest lessons from following and being mentored by Benjamin Graham is that Benjamin Graham prioritized and emphasized and focused way too much on cigar butt companies where their financials look doo-doo, where the fundamentals are a little shaky, but there was the prospect of them 3xing because of a fill in the blank, right? Instead, Warren Buffett decided that approach is a little too risky and it's not conservative at all. So instead, he bought into high quality compounders when they were on the operating table. Does that make sense? Companies where despite their stock price getting slashed 40, 50, 60% off, their revenue was still increasing year over year. Their net income was still increasing. Their balance sheet still looked superb. Their dividend profile was healthy and sustainable. That's exactly what I'm trying to copy and replicate. And so I would take it a step further and argue, I don't want to argue, I'm sorry, I hate that phrase. I don't want to come off as a guy that's abrasive, right? And so what I'm trying to communicate is, I think the Mag 7, except for Tesla, I think every single one of them is S tier. Tesla, all right, let's pull it up and I'll talk about why I don't think they're S tier. Because number one, their valuation is just absolutely absurd. A 357 PE ratio for their trailing 12 months, 173 predicated upon their future earnings. But more importantly, if you take a look at their top line, it's not increasing year over year. And I would say since 2024, it's been stagnant and declining. They reached a very high of $97 billion, and now it's just dropping. And that's because he's making a big pivot into producing what is it called? Like Optimus Prime or whatever, those robots, instead of producing more cars. So right now, Tesla's in a really big transformation period. And then also SpaceX is about to go public. So Elon's a very busy guy right now. So right off the bat, I don't like their valuation. Like if their PE ratio was closer to like a 50 or a 40, then I'd be like, okay, you've got my attention. But when it's over 100, to be honest with you, you're priced for perfection. And then historically, Tesla, they don't really trade based on their financials and fundamentals. They trade based on speculation and hype. And that's because there's a cult following to Elon Musk, right? There's people that just absolutely believe everything that he says he's going to do. And so they buy into Tesla for the promise of the future. And then number two, I don't like how their gross sales is declining, right? And they also don't pay a dividend. And if you look at their balance sheet, let's take a look at their total debt situation. Honestly, that's not too bad. $8 billion of debt to that of $44 billion of cash on hand. He absolutely has the financial means to initiate a dividend, but no dividend is number three. But then also, another thing that I don't like about Tesla is it's way too cyclical. Literally every year and a half, is soars to the moon and then sells off, soars to the moon and sells off. They almost behave in a way like Bitcoin. Like obviously, since its inception, Bitcoin has only gotten bigger. But Bitcoin, just like Tesla's stock price, there's highs and lows baked in every year and a half. So as a buy and hold oriented investor, that doesn't really appeal to me with Tesla, right? Bitcoin, it's a different story. I'm bullish on Bitcoin, but that's for a day and a story of its own. With Tesla, it's like, well, what if you buy into it not knowing that it's the peak? Meaning in the next 6 to 18 months, you're only going to see your position go further into the red until they rebound and do it all over again, right? That roller coaster ride, it's just not for me. Now, having said all of that, you might think I'm a hater, but I'm not. Because if you take a look at, oh dear, I was going to say their PEG ratio might be good, but to see their profitability per share only decrease since 2023 from $4.30 down to $1.08 in the trailing 12 months, there's nothing about Tesla that validates and supports their high and fat valuation. I mean, 173 times their future EPS. Guys, I just don't know about that one. Funny enough, I would still say Tesla is a B because they defy the odds and they are an outperformer. Like if you compare Tesla to 97% of the other publicly traded stocks, Tesla outperforms. So because of the stock performance alone, I think they're like in the B, maybe in the A tier bucket, but financially and fundamentally, no. And I'm a financially and fundamentally motivated guy. Like I need to see that your data and numbers look excellent. I don't really like investing into hype, narrative, speculation. I've been burned really badly in the past, and so I just try to stick to the tried and true, the ones that are pulling off numbers that are growing every year. Case in point, if we jump on over to Microsoft, this is a company that I've been dollar cost averaging into ever since they dropped below $400 a share. I sold out of them last year when they were at their all-time high, like somewhere around here, like 480 to 490. I think it was closer to like $4.99. Obviously, I didn't catch their absolute top, which was $5.55, as depicted right there. But pretty happy with the gains that I got out of them. Believe me when I say that I had no idea that Microsoft was going to sell off this freaking hard. So after they dropped below $400, I started dollar cost averaging back into them. And if you take a look at their financials and numbers, it's an entirely different ball game from Tesla. Their forward trading multiple is a 20. So they trade for 20 times. Their stock price is 20 times their future EPS. And the average PE ratio in the S&P 500, or I guess the future PE ratio, the forward trading multiple, it's a 21. So Microsoft trades below that of all of the other blue chip household names. If you take a look at their EPS situation, 2005 it was $1.12 of profits per share. Now it's $15.99 of profits per share. It only goes up year after year, right? You take a look at their balance sheet, they have $89 billion of cash on hand. There's a lot to like about Microsoft, especially considering that their business is so diversified. They make money from almost every venture that you can think of, right? Windows, gaming, social media, as in LinkedIn, operating system Windows, Microsoft Suite, Azure. A lot to like about this company, but I also want to highlight their dividend profile. A 9.8% dividend growth rate. Friends and family, at a 9% growth rate, that means your payout would double every 8 years without you contributing any more money to Microsoft. So even though the yield might be low, you need to take that into consideration that the payout doubles every 8 years. So with Microsoft, the numbers, financials, and the data, it looks spectacular. It looks good. So that's one that I've been buying into. And obviously, I disclosed that in the public portfolio. And if you made it to this point in the video, I'm going to reward you because I'm about to tell you the next company that I'm going to be buying into this upcoming week. Not at its current, I'm clicking back. Okay, not at its current price point, but if they fall further, I'm going to jump in. And friends and family, that's going to be Meta. I'm not recommending or encouraging anyone to copy me. I'm just telling you what I'm doing, right? This whole channel is about me sharing my journey, my lessons, my mistakes, and I'm sharing it with you guys. Right? So Meta, their forward trading multiple is a 17. So you might think, oh, things might be slowing down. They might be losing their edge on advertising. Their EPS might not be growing year after year. That couldn't be further from the truth. Friends and family, Meta's top line, their gross sales in 2009 was $700 million. Now it's $200 billion in revenue. That year over year, that change was 22%. You take a look at their bottom line per share, it's $23.49 of profits per share. Absolutely bizarre. You take a look at their balance sheet, they also have $81.5 billion of cash on hand. Obviously, the free cash flow situation across the Mag 7 right now, I would say the free cash flow is not a fair valuation because they all, in advance, they've announced that they're going to be spending billions of dollars on building out data centers. So that CapEx, alongside with the stock-based compensation and everything else, it's eroding and it's eating into their potential free cash flow, right? So if you take a look at their capital expenditures, it's only getting amplified. It's $69 billion of CapEx. And so if I scroll down and show you their free cash flow situation, yeah, it reached the high in 2024, $54 billion, and now it's $46 billion because they're using the free cash flow from their operations in order to future-proof their business. Because I tuned in to the Google's, or I guess Alphabet's earnings, Amazon's, Microsoft's, and they all said pretty much the same thing. We're tapped out. We've reached full capacity, our bandwidth. We cannot take on more customers and their demands unless we build out more data centers. So from what I heard, is our business is crushing so hard, we need to lay down the foundation today so that we can continue to increase our numbers at a double-digit rate going forward. If you don't do this right now and we don't build out more data centers, we're going to be tapped out right now. What you see is the best that we can do. Likewise, if you take a look at my public portfolio, I'm really bullish about CapEx heavy companies because of the economic moat that it builds. Because if you have 10 factories and your competitor only has one factory, you have economies of scale. You're going to be able to produce 10 times as fast against competition. And a real world example is Eli Lilly versus Novo Nordisk. Eli Lilly doubled down on their supply chain on the GLP weight loss drugs, whereas Novo Nordisk, they were like, we'll do fine with our one or two production facilities. And then you fast forward, the true winner became Eli Lilly because they were able to produce more of the drugs and get it out to the market and into the hands of the customers. Whereas with Novo Nordisk, they were bottlenecked. They couldn't produce more. And so when I hear and digest information like that, CapEx is what separates you from the competition. And we already know that the ROI from the data centers, they're going to be using that to sell more cloud subscription services. They're going to be able to take on more AI endeavors. That's going to be generating money in the future. So for me, I like CapEx. And I said it again and again on this channel. It's unpopular, but I like it. CapEx for me, I'm bullish about it as long as you're doing it in a wise manner. If you're up against the wall, and you have nothing left, and then you decide to do CapEx because your business model is diminishing and it's being disrupted, then of course I don't like it. But if you're at the top of the game and you're trying to further your economic mode or produce more growth in the future, I bless off on it, right? Something else that I really like that rubs people the wrong way is stock-based compensation. I say it again and again on this channel. I love stock-based compensation because if the leadership team has skin in the game and their compensation is highly contingent upon the stock price being successful, then it aligns the interests of the shareholders to that of the employees of the company, right? If you don't give a crap about the company's health and you're just putting a butt in a seat, and you don't care what happens as long as you get paid, you're not going to care if whatever your project you're working on is successful or not. But if 40% of your compensation is tied up in RSUs, you're going to make darn sure well that whatever it is that you're working on is going to flourish, you're going to pour your heart and hard work effort into it to make sure that it's successful, right? Because as you do that, and every other employee across the company does that, it compounds in a way where it shows up on the P&L and your net income is crushing, right? So for me, I think because I worked in corporate America, understanding stuff like this, I like CapEx and I like stock-based compensation. Obviously, the popular opinion is, no, I hate stock-based compensation because you dilute the shareholders. I hate CapEx because now the free cash flow is smaller. Like, I get that side of the spectrum, but that's very short-term sighted. It's just like Wall Street analysts. You're only thinking about the next 3 months. I like to think strategically for the next 10 to 20 years, and that's because I come from a strategy background. My last position was as a strategy director at a pharmaceutical company. So I like to think strategically for the long term. You got to plant the seeds today so that 5 to 10 to 20 years from now, you can sit in the shade of the tree that's huge, right? In California, Yosemite. You can't have a tree if you don't freaking plant the seeds today. That CapEx is required. So I'll get off my soapbox to say, for me, Meta, I really like, just not at their current valuation. I'm still waiting for them to drop a little further. I still remember when I bought into Meta at $89 a share. When was that again? At the end of 2022, when everyone kept saying, oh, Facebook, Instagram, they're cooked. This business it's over. And I kept thinking to myself, hold on, guys. The financials and fundamentals of this company is absolutely spectacular. And you're telling me that they're done? And I think their trading multiple at the time was like an 8 or a 9. And right now, their forward trading multiple is a 17. So I'm going to wait a little further. But yeah, other than that, the United States men's national team, they just played against Belgium, absolutely destroyed. The first half, I feel like it was fair, right? I think the U.S. spectacular performance, but the second half, my gosh, did we poop our pants. It was a belt-to-ass performance by Belgium. To be honest with you, it makes me a little nervous about the World Cup. And for those of you that are out of the loop, I'm a stay-at-home dad raising my first baby right now. So Monday to Friday from 5 a.m. to 4 p.m., I do it all. The diapers, the laundry, the cooking, you name it, I do it. And the funny thing is, maybe it's my ego, maybe I was just ignorant because of my background and my resume, right? I was an infantry officer prior to going into corporate America. I thought being a stay-at-home parent would be easy peasy. Like, how hard could it get, right? This is a little baby. But my goodness, full transparency, it has been difficult. I have been challenged beyond belief by the hour, by the day, by the week, to the point where I'm literally, my hairline has been receding. And it's got me questioning myself about everything. Who am I as a man, right? I'm definitely not as tough as I thought I was. You know, some days, they're not so bad. But as I say this, I'm reflecting on the really bad days. Dude, I just think to myself, how the heck do parents of twins or triplets do this? Because I'm struggling with just one little baby, right? But slowly, you know, I'm learning that parenting, it's not about being tough. It's not about being an alpha male or any of that nonsense crap. Parenting, it's about showing up again and again. Knowing full well what's to come the next day. Knowing that you only got 3 hours of sleep, being exhausted, and choosing kindness and patience, even when it's super difficult to choose that path. So, in a weird, bizarre way, this chapter in my life, it's teaching me emotional regulation and self-control in ways no other experience has ever taught me. Like, I love about reading up on that kind of stuff in literature, but when it's time to actually live it out in real life, it's so much more difficult. But I think through that, hopefully she grows up with a kind father, right? That doesn't raise his voice, that doesn't cuss, that doesn't break things. Because right now I'm putting in the repetition and the practice so that she can talk to me about anything and I can be a good dad where she doesn't fear him, right? I feel like if your parenting style is that you have to instill fear into the child, bro, you've got it ass backwards. Now, obviously, that's just my opinion. So parenting at the end of the day, obviously there's going to be a lot more reflections and lessons to come. I think it might be the hardest and the most meaningful job I've ever had, because eventually she'll grow up to reflect the moral system and character of me as well, right? Because children and teenagers, they tend to emulate their parents. And so if I can do a good job of raising her to be a kind soul, someone that cares about her community and taking care of people around her, but also as a dividend growth investor, I would be super proud as a dad. Anyways, I'm rambling. I'm looking at the clock. I've got to go. I got to get groceries for this upcoming week, so I'll talk to you guys later. Stay safe. Good luck in the stock market, and I love you. See ya.